for the final exam. So we're going to go today through practice final 1, which is under the heading practice final. And then we'll just continue on like this. As I said, as we get a little closer to the final exam, we'll do some mock finals as well, so that we should be in pretty good shape by the time we take the exam during finals week. I am taking attendance. I did have to reprint the attendance sheet because I couldn't find the other one I had. Today is what, November 16th, 14th. So please please sign next to your name under November 14th. I am going to continue to monitor attendance. I am going to drop people who don't attend because I just don't feel like giving out Fs. I'd much rather withdraw you than sit here and have to hand an F out to somebody. So do make sure that you're signing in, okay? Okay, good. So let's go ahead then and let's jump ourselves up to this Word file. And I did put a couple of the slides. We're going to focus first on Chapter 6, which was absorption versus variables costing. And I put a couple of the slides just because, as I said, when we went through this material, absorption versus variables costing isn't something that somebody just walks around with, bouncing around in their head. So I think it's better for us to review some of the basic things that we said last time. We don't have to go into a great deal of detail from the lecture standpoint because our objective here is to work problems. But notice that for absorption costing, our product costs, or what we learned way back in chapter whatever, first couple of chapters, our product costs are going to be our direct materials, our direct labor, and our overhead, both fixed and variable. Those are assigned to our products. We put them into our finished goods inventory. As we sell those items, those costs hit the income statement through cost of goods sold. Our period cost, our selling and administrative, both fixed and variable, are always expensed every period. They are not part of our product cost. So they don't spend any time on the balance sheet and finished goods, right? They go straight from being incurred straight to the income statement. Okay? When we talk about variable costing, again, direct materials, direct labor are considered product costs, but only the variable portion of our manufacturing overhead is considered a product cost, right? All other costs, both our fixed manufacturing overhead, which is a period cost for absorption, which is a product cost for absorption, is going to be what? A period cost under variables along with the selling administrative, which is the same thing for absorption. So the difference between the two is how we treat our fixed manufacturing overhead, right? In one case, we're simply going to expense it under variables. Under absorption, we'll do what? It'll eventually hit the income statement, but we actually have to sell the items in order for it to hit the income statement under cost of goods sold. Okay, so we talked about that last time when we looked at Chapter 6. And the other thing that we noticed, even though we learned about the contribution margin format for the income statement back in Chapter 5, remember that using variables costing is really what yields us to be able to use a contribution format example for the financial statement. Now what we have here is an absorption where we have sales minus cost of goods sold gives us what? Gives us our gross margin. Included in the cost of goods sold are only our product cost, right? Okay, and we have to actually sell those items to get those product costs into cost of goods sold. That gives us our gross margin, and then we have our selling administrative costs that come up in the calculation of our, and they're saying net income here because I guess they're assuming this company doesn't have any interest expense or any gains or losses from selling property, equipment. If they did, then this number would be operating income, and then we continue to consider those items for net income. But since I guess they didn't have any of those items, they're calling that net income. If we were sitting here and using, and I just want to jump down, I thought I'd give you the contribution format for the financial statement. No? Okay, well, we're going to get it right now then. Contribution format for the financial statements. Ugh. Well, I'm going to write it on. I'll just write it next to it. How about that? Because I thought I had contribution format here. I know I pasted it in there. I don't know why it didn't print out for me or paste in for me. I thought I had it. So if we are talking about what? If we're talking about the contribution format, we will have our sales minus our variable costs. And our variable costs now will pick up what? We'll pick up all of our variable costs, both product and selling. That'll give us what? Contribution margin. And then we will take off what? All of our fixed cost. Both what? Both product, well, not product, but what? Manufacturing overhead is included in there. Not all our product costs, but our manufacturing overhead portion of our product cost. And then what? All of our selling and administrative fixed costs, of course. Okay, but the contribution format does what? Takes sales minus all variable costs. And when we say all variable costs, we mean all variable costs, right? Because sometimes you say, well, what about this variable cost? Variable costs, all variable costs, whether they are what? Whether they are selling, whether they are product costs, right? That gives us our contribution format, our contribution margin, and then what? And then we take off our fixed cost, all of them, including our manufacturing overhead and our selling and administrative fixed costs in the calculation of net income. Okay? So the difference between the two is how we treat our fixed manufacturing overhead. One case, we're going to include it as part of our balance sheet, part of our costs on the balance sheet. In the other case, we're going to always expense all of it in the case of variables. Okay, so which of the following cost method charges all manufacturing costs to product? That's absorption, right? We have our what? We have our direct materials, direct labor, our variable manufacturing overhead, our fixed manufacturing overhead are all considered product cost, right? Okay. Number two, we have this Mentor Corp has provided the following information for the current year, and they want us to calculate the unit cost using absorption. So if we're using absorption and we want to calculate our unit product cost, let's see which numbers we should pick up. So unit product cost, is it going to include direct materials? So we're going to go ahead and we're going to pick up that 70. Good. How about direct labor? Direct labor's got to be included, so we'll pick up that 55. Good. How about variable manufacturing overhead? Huh? Under absorption, all of our product costs, it's even though we didn't call it that at the time, it's what we learned back in chapter 2 or whatever, all of our direct materials, direct labor, and all of our overhead, both variable and fixed, right? Okay. So how about the fixed manufacturing overhead? Am I going to pick that up as a product cost? So I take that 350,000. I'm going to divide that by what? By the number of units produced, which were 3,500. So what's that, $100 per unit? So they want us to do it by unit. Anything else? Anything else? We do not pick up selling and administrative, are never under either method are they part of our product cost, right? They're expensed under both methods. Never do they hit the balance sheet. They go straight to the income statement. So when I add all that up, is this 245? Okay. Okay, good. And you can see the solution right there as well. Okay, good. Let's take a look at this one now. And it's the same information, but now, no shock, they're asking me for what? variables costing. So we should be able to go through this same table and now pick it up for variables. So how about the direct material? That's a product cost. How about my direct labor? That's a product cost. Good. How about my variable manufacturing overhead? That's a product cost of what? $20? Anything else? All the rest, what? All fixed costs, and of course, all selling administrative costs are always expensed under both methods, right? And so they are not considered a product cost. And so when you add that one up, I guess you come to this 145. Yeah, because it's $100 per unit different. In fact, if you were taking a question like this on the test, you'd just have to not include the 100, right? Okay. You go around already? Everybody sign this already? Okay. Okay, good. Question on that? Okay, good. Let's go over then and let's take a look at, you can see the table there giving you the solution. Let's take a look at a couple more of these. Using a traditional costing approach, which of the following manufacturing costs are assigned to products? Traditional approach is the same as what? Absorption. Okay, that's what we learned in the very beginning was absorption. When we call it that, that's a traditional method, right? This is what's required by GAAP. Generally accepted accounting principles say when you're preparing your financial statements, you have to use absorption. They don't allow us to, expense costs just because they're fixed. We have to leave them on the balance sheet until we sell them for those fixed manufacturing overhead costs. But let's go ahead and take a look. Under traditional, we have what? Variable manufacturing overhead, yes. Direct materials, yes. Direct labor, and the fixed manufacturing overhead, right? So this question's almost teaching us again what we mean by absorption, right? Okay. Okay, good. Number 6. Which of the following statements is true? Variable costing treats fixed overhead as what? As a period cost, right? So these two questions, 5 and 6, are pretty good in that what? They sort of lay out the key differences between the two methods. I mean, if you understand these two questions, then you understand how you're going to treat the more, calculating type with the numbers in them and stuff, right? Okay. Okay, good. Speaking of which, let's take a look at this one. During its first year of operation, the McCormick Company incurred the following manufacturing costs: direct materials, direct labor, variable overhead, and fixed overhead. The company produced 25,000 units and sold 20,000 units, leaving 5,000 units in ending inventory. And I'm like, why'd they have to say that? I mean, I would have liked to have seen you calculate that, but whatever. Obviously, there's 5,000 left. If you produce 25,000, sold 20. I don't think they had to tell you that, but there it is. They helped you out there. What is the value of ending inventory under absorption? So we know we have what? Those 5,000 units, right? And all we have to do is put a dollar amount on those 5,000 units. So should we pick up the direct material? Got to pick that up. Good. That's $5. How about the labor? Got to pick that up. That's $3 there. How about the variable overhead? Got to pick that up. That's $4, right? Right? How about the fixed overhead? Good. So we know we have to pick up what? The 250,000. Now, do we want to divide it by the number of units produced or the number of units sold? Divide it by the number of units produced so we get a cost per unit. Once we get the cost per unit, we're going to what? Treat as a cost the number of units sold, treat as an inventory the number of units still on hand, right? But we still have to come up with that cost per unit produced, which they said they produced 25,000. So what's that give me? 25,000 divided by divided into 250,000. What's that? $10? Okay, so that gives me $10 per unit. I add all that up. I get what? This 22. Is that the number? Okay, so 22 times the 5,000, I guess that gives me this 110,000 down here. Okay. Now what happens? Notice we give you one here where you can compare the two. If we're doing variables, are we going to pick up this 5? We're going to pick up the 5 for the materials. Got to pick up the 5. Got to pick up what? The labor, which is $3. Got to pick up the variable overhead, right? How about that fixed? Don't pick it up under that method, right? So what do we get? $12 now? Times the 5,000 units and ending inventory is 60,000. So the question is, well, what happened to that other $10 per unit? That other $10 per unit got what? Got expensed, didn't it? Okay, and it got expensed to the tune of 10,000 times what? I mean, $10 times what? Times the 25,000 units produced. So 10,000 times 25 is going to be, 250,000. Whoops, but that's not right. It's not the 225,000 units produced. It's what? It's the 5,000 units that were in ending inventory, right? It's the 5,000 units in ending inventory that we expense those under variables, whereas what? Those are still sitting on the balance sheet in inventory under absorption, right? So the difference is what? 50,000? Okay. And so in this question, if I gave you these two questions back to back, you simply could have done what? You could have taken the absorption income and say, well, look, since I expense for 5,000 units, that $10 per unit, that means that variables is going to give me a $60,000 net income, or $50,000 less of net income, right? Okay. So you really didn't even have to do all that calculation. I mean, however you wanted to do it, but you could have just picked up the fixed manufacturing overhead per unit plus the times the increase in inventory. Increase started at 0. We now have 5,000. So we increased our inventory. That increase in inventory is still sitting on the balance sheet, right? Right? Okay. Okay, good. Come over. Let's take a look at this one. Product cost per unit under absorption. Direct labor. Direct materials. How about variable overhead? Got to pick that up. Now it's what? 280,000 divided by what? 28,000 units. That's $10 per unit, I guess. Okay, good. How about the fixed overhead? Absorption, we got to pick it up, right? 24,920, and I guess we could have added those both together and divided by 28,000, whatever. What's that come to? $29 per unit? How much? $3.29? 39 cents? Like that? Okay, so that's going to give us this, add that on this 3.39. Okay, and we add that all up. Is that this 6039? Okay. Okay, good. Is this the same information now or different? Different? Okay. So what is this? 13 for the materials, for the labor, 18 for the materials. The variable overhead, should we pick that up? 220,000 divided by 20,000 units. What's that? $11 per unit. Okay. How about this fixed? Nope, we're not going to pick that up, right? And so we add that all together. Is that 42? The 42? Okay, good. Let's look at this Hayes, and they want to know the product cost for absorption now. Okay, should I pick up the direct materials? Got to pick that up. Should I pick up the direct labor? Got to pick that up. Should I pick up the variable manufacturing overhead? Got to pick that up. Good. Should I pick up the fixed manufacturing? Got to pick that up. That's 24,000 divided by units sold or units produced? Units produced is 75,000. I mean 750, excuse me. So that's 24,000 divided by 750 is 32. Okay. And anything else? How about these selling administrative? They are not product cost, right? Okay, so I add all that up. That gives me 98. Okay, good. What if it's variables? 98 minus what? Minus the fixed manufacturing. Right, we're going to subtract that out, which is what, 32? So that gives me 66. Okay, and again, you could do it that way, or you could, that's the solution. I think the next one I included in asked you variables now for the same one, which again, you know, my advice is if we give you back-to-back questions like that, you just simply don't have to go through and add everything back up. Just subtract out the fixed manufacturing overhead, right? Give you the same answer. Okay. Okay, good. Advanced company. Okay, and I'd pay particular attention to this round of questions because I think what I did was I looked at your final, and I think they asked one of these about this advanced company. I picked up the whole slew of questions where they asked a series of questions, but one of these is one of the ones that you're going to see on your exam. Okay, so let's just go ahead and take a look at this advanced company, and cost per unit under variables should be what? Should we pick up the materials? Yes. $9. Got to pick that up. Good. How about the labor? Yes. Got to pick up the labor. Good. How about the variable overhead? Yes, we do. So we take that 75,000 divided by what? By the number of units produced, 25,000. That's what, $3? Okay. And so we pick all those up. That's what, 23? Okay, good. How about if I asked you fixed, what would you do here? I mean, not fixed, but absorption. I'm just going to take the 137,500, divide that by what? By the 25,000 units. That gives me a cost per unit of 5.5. So I simply add in the 5.5. That gives me what? 28.5. I think they asked that down here. Yes, they did. There it is. Okay. Okay, good. What is the cost of the finished goods inventory under absorption? Now we know we got to pick up what? We got to pick up that 28.5, don't we? Right? And now you go back up into the problem and you want to see, well, what do I have in ending inventory, right? So if you produce 25,000 units and you sold 15,000, how many do you have left in ending inventory? 25 minus 15,000, good. Means you've got 10,000 in ending inventory, right? Okay, so what does that mean? 10,000 in ending inventory then times what? 28.50 per unit that we calculated up there. 28.50 per unit times, what do we say, 10,000? 10,000 units in ending inventory means ending inventory is going to be what? 285,000, right? Okay. If we were to do that under absorption, what's it going to be? Is it that painful? So it's going to be what? It's 10,000, not $10,000, but what? 10,000 units, right? And what? We simply now need to leave out my fixed manufacturing overhead per unit, which was this 5.5. So what is it? $23 per? Right? So it's the 10,000 units times the $23 per unit. Would you say is going to be 230,000? Okay. So we leave out the what? We leave out the fixed manufacturing overhead when we're figuring our product cost. That means our ending inventory is $230,000 less, right? Hello? I mean, thank you. $25,000 less, which is, thank you, which is what? Or is it 25,000? It's the 55,000. It's the what? 550 times what? Times the 10,000 units, right? So that gives us the 55,000. Okay. Okay, good. Now we say, given this information, then, if the product sold for $50 per unit and we have operating expenses of 200,000, compute net income under absorption. So if it's $50 per unit as a selling price, how many units did we sell? 15,000. So that gives me selling price of Huh? 750,000. Okay, good. Then I'm going to take off my cost of goods sold from that. So there's my sales. Let's just label these. Minus cost of goods sold is going to be, what was it, 28.50? What was the price per unit? Under absorption, 28.50. Price per unit under absorption, 28.50. Times how many units? Times the 15,000 units equals you don't get a whole lot out of just sort of waiting for your colleagues to make the calculations. Trust me, there's something to be found in the actual thinking through it and doing the numbers here. 427,000, you say? 500? Okay, and so when you subtract that out, you get a gross margin of how much? 322,500. Okay, good. And then they tell us that we had what? They just tell us the selling expenses is going to be what? 200,000. They just gave that to us. So we have what? 122,500 as our, they're calling it net income, whatever. I think they should be a little more careful by calling it operating income. But if they don't have any revenues, any interest revenues, any interest expenses, no gains or loss from sale of equipment, no investment gains and losses, those sort of things, then yes, I guess it would be net income. But that's somewhat of a leap for them to just call it net income. But I'll let it go. I won't write into the book on that one. Okay. How about variables? Same facts, variables. Sales are still what? 750,000. My cost of goods sold now, though, is what? Now my cost of goods sold is going to be $23 per unit. Is that what it was? Under variables times what? Times the 15,000 units gives me what? 345,000. Okay, good. So that gives me now a 405,000. 40,500? No. 405,000? Okay. So that gives me this 405,000 now, doesn't it? Okay. But now I have to go ahead and do what? I have to take off my operating expenses, but I also have to take off my fixed manufacturing overhead, don't I? Because I subtract that. Right? So it's 550. Was it $5.50 the fixed manufacturing overhead? Well, actually, I don't even have to do it. Oh, I'll do it per unit. What the heck? Times how many units? No, number of units produced. Now I'm going to expense all of it. I'm going to expense all of it. 55. Wait a minute. I need to expense all of it. Was it total 55,000? Times the 25,000 units produced. Okay. I could have just picked up the whole number that they gave me originally in the problem, I guess. Times the 25,000 units produced. So that's how much? 137,500. Okay, good. And then I also have to then take off the operating expenses, which they just told me what it was. Operating expenses are what? 200,000. Okay, so when you take the 405 and then you subtract off the 137 and you subtract off the 200,000, what do you get? 67,500. Okay, and so I think that's the next question, right? The 67,500. Okay, so you're going to expense all of the fixed manufacturing cost incurred, right? Okay, under variables. Now I could have also did what? I could have also took the increase in inventory for the period, and so they produced 25,000 units and they sold 15. So they added 10,000 units to inventory, didn't they? Hello? Yes. So since they added 10,000 units to inventory, and the fixed cost per is what? 5.5. That gives me the 55,000. Okay. And so I could have done what? I could have taken the 55,000 and subtracted it off of 122,500. Would I get the same answer? 122,500 minus the what? 55,000 would have also given me this 67,500, because the difference between the two is how we treat the fixed manufacturing overhead. Fixed manufacturing overhead is what? Expensed under variables. It sits in my product cost until I sell it under absorption, right? Okay. Okay, so that's a good little set of questions there for you guys, and that I think it runs us through everything, right? How do we calculate the unit cost per unit under both methods, right? Oops. How do we calculate the unit cost per unit under both methods? How do we calculate the amount that was in inventory, I think it asked, under both methods, right? How do we calculate the net income under both methods, right? So if you understand that set of questions, you're in good shape for Chapter 6. And the other ones we looked at as well. We'll be having more of those as we move along. Okay. Question on Chapter 6? Okay, Chapter 6 was probably the tougher chapter of the ones, okay, that we need to get ready for the exam. Maybe a little bit when we start getting into Chapter 7, I think had some couple of, no, this is chapter 7. Chapter 7 is a piece of cake. This is, didn't we do 1 through 5 on the final, on the midterm? So this is now, that was 6, now we're jumping into 7 here. This is 7 now, this is budgeting, okay? Budgeting stuff was pretty easy. It's chapter, I can't remember now, no, what's the one where we had to allocate the cost and all that? Anyway, you'll remember it when we get to it. I forget. I don't know the chapters. Okay, but we'll get to that one. You'll see. But this chapter is pretty easy, as is the chapter that came after that, which is chapter 8. Chapter 8 is pretty easy in that it's simply going to be what? The standard costing. Okay, so a couple of easy chapters here now. Let's take a look at this one, Turnbull budgeted sales. And for these, most of the managerial accounting questions, I suggest that you go to the call of the question. Unfortunately, they made some mistake with the way they put together the final exam, that they got the call in the question, they messed it up. They used this thing called Easy Test, and I think they didn't use the software correctly, and so the call of the question gets shoved into the middle of the question. Sometimes it's at the beginning, and I told you guys that I was going to complain about that, and you said, no, don't bother, so I didn't. So it'll still be that way on your test, but they should fix that. But anyway, it is what it is. But so we're looking for what? You got to find the call of the question. They're looking for cash receipts, okay, for September. And so let's just read the fact pattern here. And they tell us that this Turnbull Corporation budgeted sales of $120,000 for July, $211,000 for August, and $198,000 for September. Experience indicates that none of the sales on account will be collected in the month of sale, 60% in the month after the sale, and 36% in the month, the second month after the sale. 4% is uncollectible. What are we going to do with that when they tell us the uncollectible amount? Ignore it, because they're not going to collect it, right? So that does not go into the calculation of cash receipts. So since we collect in the month after the sale, and they're asking me September, we won't collect any of the September in September, but we will collect what? 60% of the August sale in September, right? Okay. And then what? And then they tell us that they had what? They had 120,000 in July, and since it's 120,000 July is the second month after September, isn't it? Or September is the second month after July, I should say. And so what happens? It wouldn't be until September that they'd start to collect the 36%. There's 4% they're not going to collect. But that 36%, they would have collected that in September for July sales. And so you add the amounts collected in September for August, the amounts collected in September for July, and you get this 169,800, right? Okay, good. Sioux City estimated the following. How much cash should they collect in what? In April, and trying to underscore that. How much should they collect in April? And they tell us that 60% is collected in the month of sale, and 35% in the month following the sale. 5% is what? Uncollected, so I don't worry about that. So if we're talking about what is going to be the amount collected in April, then 320,000, I think they just give it to us here. I'm not going to rewrite it. 320,000, which was my April sales, is collected in April, isn't it? So I'll get that. And then what? And then April is the month following March, and they tell us that what? 35% is collected in the month after the sale. So in April, we'll collect 35% of March sales. We add those two together. That gives me the amount that should be collected in April for my April sales, my March sales. Yep. Okay. Okay, good. Let's take a look at this one. And this one wants us to get into how many units do we have to produce. Okay, and they tell us that they have expected sales, and they're asking us for November, and they tell us that they like to maintain 30% of the next month's estimated sales as inventory. And I do these problems exactly the way the solution is showing here. This is the way to do them. Since I know I want to try to sell 25,000 mugs in whatever these things are, these mugs, in November, I figure, okay, I'm going to make sure that I at least produce what? 25,000. But then I want to have 30% of the next month's sale. Well, the next month's sale is December, isn't it? That 31,000. And so I need what? 30% of that, or 9,300, to be available in ending inventory at the end of November. But I would have done what? I would have started November off with 30% of what I needed for November, right? So I can subtract that out, and that gives me the answer here, 26,800. Now, a common mistake, I see it all the time, what students do is they want to pick up what? 28,000 and multiply that by 30%. That's what they would have had to start October, not November, right? So then students will say, well, what are we supposed to do with October? And the answer is nothing. You're supposed to ignore it, right? Okay, so be careful with that. Okay, good. Come over and let's take a look at this one. And we want to know how many units they're going to produce in November. And this one, we don't even have to even do any calculations. They tell us that they want to, I mean, we have to add these numbers up, but they tell us that they want to sell 30,000. They tell us that they want to have how many units on hand? 6,500. So I guess we'll have to produce those too if we want to be left over with anything. But we started the month with what? With beginning inventory of 8,000. I mean, that one's even easier because you don't have to do any percentages here to calculate what I needed or what I had at the beginning of the year, right? Okay. Now this question, I've given this on exams before, and I find that what happens is students look at all of this and they go into shock and panic, and they say, oh. And then meanwhile, you look at it, and it's the same thing that we've been doing for these other questions. This financial statement right here is a distractor. This is just given to you here to make this problem look like it's got more to it than it does. Everything that I need to know about this question, but we're afraid to ask, is sitting right there in those bulleted points up there. Okay, so let's see if we can fit it all on the same screen. Where they're sitting here and they're giving me this information and they're asking me for the expected cash collections in December now, right? Okay, so since they're asking me for December, let's look and see what they tell us about cash collections. And they say that sales are budgeted $260,000 for November, $230,000 for December, and $210,000 for January. Collections are expected 80% in the month of sale. So if I have December sales of $210,000, what do you want me to do with that for December cash collections? What do you want me to do with the $210,000 for December cash collect? Don't go into a coma on me here, guys. This isn't, television. Okay, so we've got what? We've got $210,000 of December sales, and they tell us that 80% are collected in the month of sale, and I'm trying to get December cash collections. Oh, I'm sorry. 260 for November, 230,000 for December. Okay, great. Thank you. Maybe that's why you were looking at me funny. So 230 times what? What? 230,000 times what? Times 0.8 equals 184,000 of December sales will be collected in December. Am I going to collect anything else in December? 19% of November, right? Okay. So that's what? 260,000 times what? Times 0.19 is going to give me 49,400. Okay, good. Will I collect any of that January money? I'm not going to collect any of that January money in December. And so I add those two together. Does that give me this 233,400? There's the calculation right there. Okay. Okay, good. So you see how all this was nonsense, wasn't it? Okay, just a distractor. Okay. So now I come down and they say the cost of Yes, sir. Well, you do for the cash collections. Now they get down here, Omar, and they start asking the cost of merchandise purchases. So now when we purchase merchandise to sell it, we're going to want to consider its cost component, right? Okay. So you come over and you take a look, and I think it's a little easier for us to just do it in the table here. They want the cost of December merchandise purchases. Now, you come over and you take a look at first the cost of the sales, Omar, is 65%. So that's going to be a key factor now. And so I go ahead and what do? I pick up the sales for November, December, January, and you don't really need to do January here, but this table did. But all they did was take this 260,000. We're just going to focus on November. 260,000 times, what did they say, 0.65? 260,000 times 0.65 gives me what? Gives me that 169,000. Do I have a verification on that calculation? Okay, good. And then they tell us that they want to have an ending inventory, and I'm coming back up to the problem. They tell us that the company desires to have ending inventory at the end of each month equal to 60% of the next month's cost of goods sold. So I have to figure out December's cost of goods sold, don't I? And December's cost of goods sold is going to be, and I'm not going to go back up, it was December sales of what? 230 times 0.65. Is that number right there, 149? Okay. So they're telling us that we have what? We have 149,500 is my December's cost of goods sold, and they want to have how much of that? 60% of that on hand. So if you take that 149,500 and you multiply that by the 60%, do you get this 89,700? Okay. So they're telling me that they have to have at least 258,700 on hand, don't they? Okay, but they would have started the month with what? 60% of the November's cost of goods sold, right? Right? We start each month with what we need for 60% of the cost of goods sold for that month. Okay? So my cost of goods sold for November was what? 169,000, just picking that number up there, times what? Times the 0.60 should give me this 101,400. which is what they would have had at the beginning of November to cover November, because they're supposed to start the month with 60% of that month's cost of goods sold, right? Which is what we just calculated. Okay, so that means that we're going to have to purchase what? Inventory of 157,300, and we're going to pay for that. If you go back up in the problem, they tell us that what? That when it comes to their payments, they pay what? Payments for merchandise are made what? In the month following the purchase. So they would have purchased 157,000 to cover November, but they don't pay for that until what? Until December. So the answer here is what? 157,300. Okay. So you have to read carefully, obviously, for that one. I mean, that one's not one that just rolls off the page at you. You're going to have to read carefully if you get a problem like that and grind through all of those steps, right? Okay. Okay, good. Come over. And, yeah, I guess we'll just go ahead and keep going with these. We don't have that many left, but what I want to do is I want to write our formula up on the board, just because I'm going to write the formula up on the board. I don't care if they want me to or not. I'm going to write them up on the board for you when you take your test. Okay. So if I'm doing my what? We had the, right here? Right here or right here? This one's good? Okay. Okay. Yeah, and I'll continue. I'll probably have to write on that panel too. No problem. Okay, so we've got what? We've got our materials. Okay, and our materials variance is going to be what? We have price, and we had quantity, right? Use, whatever. Okay, so how do we do the price variance? Going to be actual quantity, good, times standard price minus the actual price. Very good. Maybe I don't have to have the formula. Oh, okay. He's got them printed very carefully, right? Okay, I'll put them up on the board, or either that. I'll figure it out. I'll have them. They'll be available to you. Okay. Okay, good. Then what? For the quantity variance, it's going to be standard price, and it's going to be standard quantity minus the actual quantity. Very good. Okay, that's my materials, right? How about my labor? Rate variance, good. Actual hours. Standard rate minus the actual rate. We're always putting the standard first so that if the number comes out negative, I know it's unfavorable, right? Okay. Okay, good. How about, what do they call it? Usage is going to be what? Mm-hmm. Minus the actual hours. Good. Okay, very good. And then can I kind of leverage off of the labor to do my overhead? Okay, because often what? Often, and it's variable overhead, right? We don't calculate standards on fixed because OH is overhead. Because, fixed doesn't change from period to period, so there really shouldn't be any variances here. So it's really the variable portion, and I can leverage off of this because what? Often the hours of labor are my driver in these problems, aren't they? Okay, but in this particular, we're just going to go ahead and be a little bit more careful and indicate what? That we're talking about the driver. Oops, right here. just be careful that it's not always labor hours. It could be some other driver, such as machine hours, etc., right? Okay. Now, the point of analysis on these are typically what? Typically, we have to work to come up with the actual price, right? The rest of these are pretty much given in the problems. And what? And the standard quantities, actual rate, and the what? Standard hours are the things that we usually have to calculate up because it's going to depend on how many units they produce for the standard quantity, standard hours. It's going to depend on what? The amount that they either purchased or what? Or used that's going to drive our calculations of the actual price, actual rate. Okay. When we do actual quantity, is it actual quantity used or purchased for price? Purchased, good. For price, how about for usage, quantity? The actual used. Okay? Okay, good. So I'll put these up. But, you need to make sure that you at least know the way we're thinking about these formulas so that when you're studying, not use the formula and say, okay, I'm just going to plug in the numbers. Use the formula when you're practicing with these and practice plugging in the numbers accordingly. Okay? But let's go ahead and let's try this one now. Let me get this. I think I can increase the size on this. $26. Okay, thank you. Okay. And there's no only reason that's highlighted. I have no idea why it's highlighted, so that highlighting doesn't mean anything. Okay, so who wants to try this one? You don't have to come up. You can tell me from your seat. What are they asking me here? Efficiency variance. Okay, so labor efficiency variance. So I think we called it use. The correct term is what? Efficiency. Okay, who wants to do the labor efficiency? You want to do it, Omar? You want to do it from there? Okay. Okay, good. We've got the standard rate. Standard rate is 12.10. Actual hours is 6,100 hours. Okay. 8.3. Multiply that times the 900 units. Did we do this one already? No? Okay. So 7470, you say? Okay, good. So 7470 minus the 6,100, just doing the math, that's my what? That's my actual actual hours versus what? Versus the standard hours that it should have taken me to produce these many items, right? These many units. And so that gives you 1210 times, what's the difference in the parentheses? times 1370. Okay, good. 10 times 1370 is what? 16577. It's a positive number, right? So that means it is what? Favorable. Okay. Don't do it the way this is showing. I should take that out because that makes people start to think, oh, okay, let me follow that because the book says that's the way to do it and that's easier. And I promise you it's not. Okay? Okay, good. Good job, Omar. How about this one? Materials quantity variance. Who wants to do materials quantity? Might as well practice with these guys. Okay, you want to try it? Okay. So, how about we get the formula up here? So for materials, what are we looking for? Materials quantity? Minus the actual quantity. Okay, good. So now our job is just to pull the information out of here, right? So do we have a standard price? $7, good. Okay, but we're going to have to get it times the number of units, right? So we're going to have to calculate that. Can we plug in anything else that's given here? How many kilos do we actually, and we have to pick up for what? Well, we're doing the quantity variance, right? So we have to pick up what? And so we did what? We used 21,750, right? So it's going to be 21,750. Can you believe that? This is my whole life right here. My whole life is spent writing the wrong number, erasing it, and then writing down the same number again after that. Okay, so 21,750 is the amount that got used versus what? Huh? No. What are we doing here? We're doing quantity variance, right? Yeah. So what did we actually use versus what should have we used to produce these many units, right? That's the one that we have to calculate for the quantity variance. Good. Very good. Times the 3.8 that we were supposed to use, right? To produce these 5,600 units. And that comes to 21,280, you say, John? 28,280. Eh. Some things are too sloppy even for me to leave them up there. 21,280. Okay, so I should have used only 21,280 to produce these 560, and I came over here using 21,750, right? And so $7 per unit is my standard price, and so the effect of using too many units, that's going to be a negative what? 470 times the $7 price per unit gives me negative 3,200, you say? 3,290. Okay, so negative 3,290. I hope that's the answer. Unfavorable. Okay? Okay, good. See how painful that was? See how hard it was when he had to sit there and work through it? He's just all like, he's going to go get a neck brace after that, right? Okay. Yeah. Well, that was what they purchased, and if I was being asked the price variance, then that would be relevant. Did they ask me the price variance in the next one? Yeah. Okay. So I'm going to use that for the price variance. So go ahead on, help me with the price variance. Give me the formula. Go ahead. Okay, wait. Actual quantity purchase. Let's just get the formula up here for the people that are viewing this from home. Actual quantity purchase, which nobody should be doing, but that's all right. Maybe you're looking at it again for the third and fourth time from home. So let's put the formula up there. Standard actual quantity purchase times what? Standard price minus the actual price? Okay, good. So how about then going back up to the problem, can we find the actual quantity purchased? Dude, you were just asking me about it. The actual quantity purchased, right? Okay, actual quantity purchased is 24,800. I'm just going to scroll up and down to put it in there. 24,800. Good. Do we know what the standard price is? Standard price is $7, right? Right there. Okay, so just pick up that standard price, $7. And then I just have to get the what? Actual price now, don't I? Okay, how do I get the actual price? How much did they pay? I'm going to take that 24,800 and I'm going to divide it into the 168,640, right? Okay, so 168,640 divided by what? 24,800 gives me actual price of 680, you say? I don't know if these seem so familiar to me because we've already worked these same exact ones, or if because it's just after a while it's like, you know, it's like making chicken at Kentucky Fried Chicken. I say that because I used to work at Kentucky Fried Chicken. You do the same thing every time, right? Okay. So what's the answer? 24,800 times what? 20 cents? You say is what? 4,960. And since we paid less, right, than the standard, we have a favorable variance here. So we've got what? We've got a unfavorable quantity variance and a favorable price variance, right? What might be going on here? What might this mean? Cheap materials. It's not that I was drunk when I came to work that day and wasted a bunch of stuff. It's that you bought cheap materials, right? Whatever. Okay. Okay, good. Let's take a look at this one. Materials quantity variance. Ooh. This one, oh no, they give me some of the information in the table. I was going to say, some of the problems you'll see on your exam, some of the ones I give you to practice with, all the information, a lot of the information's in like these little tables right here. The only difficulty level that we raise on the exam is sometimes I see some where they're all in paragraph information. So as we get closer, I'll start giving you some more with theirs. They put everything in paragraphs. You're still taking it and pulling it out into the formula though, right? Which I'm going to give you. So let's just go ahead and let's take a look at materials quantity then. Who wants to do this one? How about some of you back row dwellers? right? Like if we were like sitting in a club, I'd be like, "You in the back row. Who wants to go in the back row?" Okay, go ahead. Okay, you want to do the back from the what's your name again? Beatrice. That's right. Yeah. Let me fix this. Let me make it. Can you see it okay back there? Okay. As long as you can see it, then we're good. So what are we looking for here? Okay, good. Materials quantity variance. Okay. So what's my formula? Standard price. 1 second, Beatrice. Standard price, okay. Times the standard quantity minus the what? Actual quantity used. We're going for quantity variance here, right? Okay, good. So can we get the standard price? Okay, look, they're asking me here the materials quantity variance. So they tell us that we use what? We use $2 for the material, right? Okay, so that's a standard price of $2. Okay, then what? Okay. Okay, they use 3,750. Good. Okay, what's the standard quantity? What should have they used? Set it up for me. They're supposed to use what? Good. 3 kilos per unit. And how many units? Production was 1,200. Good. So what's that give me? 3,600? Okay, good. So it's $2 per unit. They were supposed to use 36. They used 37.50. Even I can do that one in my head. What's that? $1.50, 150, I should say. Beatrice? Yep. Okay, good. And that number's negative. So $2, that's going to times that negative 150, going to give me a negative 300. That's unfavorable. Is that the answer to that question? Okay, good. Okay. How about, good job, Beatrice. How about price variance? Other back row table. Beatrice saved the back row table on the left. You back to row tables on the right are in trouble now. Beatrice sitting there all proud. Yeah, I saved my table. I got two, so what's your name, sir? Ralph. We'll let Ralph do, and then you can do the next one, okay? All right, go ahead, Ralph. It's the same facts. Yeah, now they're just asking us what? Price variance now? Right? Okay, so you want to give me the formula for the price variance after the computer gets done discovering what its life purpose is? Actual quantity times standard price minus actual price, right? Okay, good. So we come up, and is actual quantity purchased or used? Actual quantity purchased now, right? I'll just put perch there for purchase. I guess I can finish writing it. Actual quantity purchased. Okay, good. So actual quantity purchased now, just going back up into the information here is what? Huh? That's the cost. How much do we purchase, huh? 4,100 is what actually got purchased, right? Okay, so 4,100. Okay, good. Standard price, I believe we know already to be what, $2 in the previous problem? Okay, so standard price is $2. What's the actual price? Oops. No. No. Oh, wait. Where are you getting 4,100 from? How much did they pay for what they purchased? Now you got to, when you're trying to get a price, you got to get a number in there with a dollar sign, don't you? So we've got this 8,610. Okay, and we're going to divide that by what? By the number of units they purchased to get the actual price, right? Okay, so 8,610. Eight 610, and you want to divide that by this 4,100, right? Notice we use that number twice in this calculation, right? In this answer, both as the actual quantity and then to get the actual price per unit. So $8,610 divided by the 4,100 units gives me an actual price of $210. Okay, so they were supposed to pay what? $2. They paid what? $210. So they paid too much for these. So 4,100 times what? The negative 10 cents gives me a negative 410, meaning it's unfavorable. Okay, good. Good job, bro. Okay. So let's try this one. And what? They're asking me for materials price variance here for this XBEZ52. And so I'm going to go back up since it's just a little easier to pick up what's going on with this XBEZ52. And this one's all paragraph information now, right? What's your names again, sir? Rizwan? Rizwan, so we're doing what? Price here? Okay, so why don't you go ahead and give me the formula. Actual quantity. What are we looking for? Price variance or quantity variance? Price variance, right? So shouldn't it be, for price variance, shouldn't it be actual quantity purchased? Okay, so actual quantity purchased times standard price minus the actual price. Good. Okay, so actual quantity purchased is what? We purchased 12,000 units of the part. Okay, so actual quantity purchased is 12,000. Good. And standard price, they tell me, is what? Standard price is, standard cost is $1.45. Good. Okay, now look, guys, one of the important things for you to get used to is what needs to be calculated. And I've circled the ones that need to be calculated so that you train yourself to look for the items that are sort of given to you in these problems so that you quickly grab those and then you just get down to that last, what I call the death blow. Right now that I've got the question about ready to just give up the answer, I punch it with that last calculation and it says, ugh! And it gives me the answer, right? Okay, so what's that last part now? They paid $18,000, didn't they? Okay. To purchase how many? You already told me how many they purchased. To purchase how many? To purchase the 12,000. 18,000 divided by 12,000 is, huh? 1.5. Okay, good. So that's 12,000 times, what do we got? A negative 0.05, which is going to give me 12,000 times negative 0.05 is 600 negative. So it's a 600 unfavorable. Okay, good. Gee, that one was a lot harder because the information was given to me in a paragraph, right? It's the same process, right? Okay. Okay, good. What are they going to do? Ask me for the quantity variance down here? Okay, so if we're going to do quantity variance, let's go back up where we can see the problem. And I'll do quantity right next to it here in red, I guess. Okay. Who wants to do this one? You want to do this one, Jarna? You broke the rule of making eye contact for more than 20 seconds, right? This gets you stuck. More than 2 seconds gets you stuck, right? Okay. So we're looking for, tell me again, we're looking for quantity variance now? Okay. So it's going to be standard price. Oops. That's all right. Standard quantity. Standard quantity minus actual quantity used, right? So we can measure the impact of having used too much or too little of this, or not too little, but a smaller amount, right? Okay. Okay, good. So what's the standard price? $1.45. We know from the previous problem is the standard price. Good. So we've got what? We've got 3,000 radios that were manufactured, and they're supposed to use what? 3 units per. So that's 3,000 radios times the 3 units per. That gives me 9,000. Okay. And what was the actual quantity that got used? No. You know, what is up with Microsoft and the updates? I mean, it's driving me nuts. It's like every time I turn around, you need updates. I just updated it. Anyway. It's not like, you'd think that after I update it, I could like write a song, a hit song off of it or something. But no, it does the same thing it was doing before. Okay. Anyway, so what is it? 3,000. 9,000. What's the actual? They actually use 10,000, right? That's 10,000. Okay, so that's going to be 1.45 times negative 1,000. Okay, so that gives me, it's negative, so it's unfavorable, right? Okay, good. Just that one down there. Again, I'd stay away from the way they do them. I don't like this. I really don't. Okay, Collins Company, huh? Got to do labor. Who wants to do the labor? What are we looking for? Labor rate. What's the formula for labor rate? It's what? Actual hours times the standard rate minus the actual rate. Okay. Do we have the actual hours? We use 5,600. Good. Do we have the actual rate? You don't mind if the problem just wimps out on you and starts giving you even more information than some of the others, do you? Right? They just tell me 1530. They don't give me the total amount. You're sitting there, what's the total amount they spent so I can divide that by the actual hours so I can get the amount per hour, and the problem says, "Oh, that's okay here. Here's the amount per hour they spent." That's easy enough, right? Can I get the standard rate here? Standard rate is what? $16 per hour. Okay. Now, I don't know how you have a standard amount and then you spend less unless you tell the people, you just got your pay cut, buddy. I don't know. It seems like the standard should be whatever it is you're supposed to pay people, but okay. Somehow they got away with paying less per hour. So 5,600 times what? Times 0.70 gives me what? Gives me a rate variance that is favorable of 39.20. Again, I think it's kind of hard to get a rate variance. I don't, unless you start renegotiating, what you're going to pay people after you've already agreed to pay them a certain amount or something. I don't know. How about efficiency? Can we do efficiency? Efficiency is going to be what? Standard rate, which we know the standard rate is what? $16 per hour? And we're going to multiply that times what? The actual standard hours minus the actual hours, right? Okay. What was the actual hours? Did they tell us? Actual hours coming back up was what? 5,600. Okay. So actual hours 16. This should be, I guess I should have put what? Standard rate here. So just to keep the formula pure up there. So 16 times the what? Times the actual hours is 5,600. What's the standard hours? For each unit of single product made, it takes how many hours? It takes 1 hour, doesn't it? And they made how many units? 6,000. So that's 6,000, right? Okay. So 6,000 is going to be 16 times what? Times a positive 400. Is that 6,400? And since it's positive, it's favorable. Okay. That's it. Okay. So what we'll do on Wednesday is we'll continue this. We're going to pick up chapter, now that was 6, 7, and 8 already? Or was the standard cost, or was standard cost part of the budgeting chapter? That was 6 and 7? 6, 7, and 8, right? Okay, so what we'll do next time, I think, is pick up 9 and 10. Okay, so we'll do 9 and 10 next time, and we'll do probably 11 the time after that, and then I think we should be. Do we have class next week? We do, right? On Monday, but not Wednesday. Next week. Next week's Thanksgiving, right? We don't get Wednesday off? Hey. They really don't give us Wednesday the day before Thanksgiving?
You're more than welcome to. You know.
Well, federal government, you only get Thursday off.
Yeah. They
Um,
give you Thursday, but they don't give you Friday.
huh? Yeah, I doubt we'll come to class on Wednesday. That's stupid.
Sweet.
I don't see any reason for us to come to class on Wednesday. But anyway, we'll talk about that. But for this, I don't mean day after tomorrow. We'll be here tomorrow, and then we'll come in. That actually might work out pretty good. And that on Monday, then we'll do the last chapter, chapter 11, and then when we come back from the holiday, we'll do mock exams, a couple mock exams. That actually ought to work out pretty good for us. So, okay, all right, guys. I will see you on Wednesday. Have a good rest of the day. Oh, make sure you signed in, please. Uh-huh. Hang on, Darren. Let me stop this just so that our whole conversation doesn't get recorded.